Hi, everyone. This is Rob Roy, and welcome to the Elliott Wave Options U.S. Market Update. As we do each and every week, we show you on the screen the stocks that will be featured in this recording. And if there's a particular stock you're interested in, you go directly to it using the chapters feature in this recording. All right, let's get to the market. Let's take a look at the chart. If you look at this ascending pennant pattern that we've been showing you for weeks now, you might notice it's a little bit different. It's a little bit wider. And if we go back to where we were before, we didn't do a recording last week due to travel. You can see that that was where the pennant was before. And then we have what I call non-farm Friday. That was this day right here where we had the non-farm payrolls report that came out with the big revision for May and June and all the hoopla you've heard about. That sent the markets lower. But as I've talked about numerous times, when you have a significant break, whether it's a moving average, support resistance line, a triangle pattern like this, you have to have a follow through or confirmation day. And there wasn't one. The next day we moved back up. That's the importance of having a follow through or confirmation day. So what that told us is that was not a breakdown out of the ascending pennant pattern. Similar to how triangles work, sometimes they form larger triangles. And that's what happened with this ascending pennant pattern. It formed a larger ascending pennant pattern. So where we spent the time from mid-June all the way up till recent and non-farm Friday in the upper end of this ascending pennant pattern above the 10-day moving average, all that did was move us to the lower trend line of the ascending pennant pattern. And as you can see, we've almost reached the AI target. While I'm talking about that, if you haven't, by some chance, gotten a copy of this software, go to hubb.com, hub.com, and get a copy of the software. It's free, and you get free Elliott Wave labeling programmed exactly to the algorithm as Ralph Nelson Elliott wrote it. There is an opportunity to subscribe to these AI signals if you want, but you don't have to. The software and the Elliott Wave signals are all free. So coming back here, the AI had identified this target of 652. And if you've been watching for a while, you've seen that target for weeks now as a potential target, but it only gave it a little bit more than a toss of a coin, a 62% chance that we're going to hit 652. So the idea has always been, do we hit that level first and then start to correct down and form a wave 4? Or do we start a wave 4, which was a possibility on non-farm Friday, to move down, create the wave 4, and then move higher and hit this AI target in the wave 5? Well, clearly, we're still in the wave 3. Moving higher, it seems like we're destined to hit that 652 level on the S&P before we start a wave 4 corrective move. I think the correction, and I just want to be clear on this, I'm not calling for any sort of a massive crash or anything in the markets, just a normal, healthy correction and a test of those February highs. As you can see, once we broke those levels, even though it looked like it on non-farm Friday, that we were coming down to test 610 and the 50-day moving average, uptrends or downtrends periodically test the 50-day moving average to make sure the trend is still strong. It looked like that's what was going to happen. It didn't, because there was no follow-through day. But at some point in time, I do think we test that 610 level, the break of resistance there from the February highs, and somewhere in the area of the 50-day moving average. But it seems at this point, there's no stopping the market. We did have the CPI and PPI reports come out this week. If you've heard me talk before, you know I don't pay too much attention to the headline of the CPI or the PPI. It's the spread. The CPI basically came back in line, and the PPI came in much hotter than expected. So that means that wholesalers are paying higher prices, but consumers are not. So that tends to compress margins. So if wholesalers are paying more for their goods, but they're not able to pass those prices on to the consumers, they make less money, so that compresses margins and therefore profits, and maybe that shows up next quarter in the earnings. It wouldn't show up this quarter, it's too soon, but it might be something to watch for next quarter's earnings. The quarter of this quarter earnings have been pretty good. So we're above the 10-day moving average. I do think we hit that 652 level, and then we'll see where things go from there. Let's take a look at the VIX. We've been talking about that a lot with whether or not we were going to break below 15. We did, and just kind of hovering around that midpoint. If we do continue up to 652, maybe that brings us down towards 12.5. I've talked about this numerous times as well, so I don't need to rehash it too much. That last summer, if we go back, we condense the chart a bit and look at last summer, we spent the entire summer down around 12.5. Hasn't been that way this year with tariffs. And is the Fed going to cut rates? Are they not going to cut rates? And it was interesting with the PPI report on Thursday, yesterday, that the Fed Fund futures went from a 100% that the Fed's going to cut in September, went all the way down to like 73, and then it turned around and went back up. The market is still expecting a rate cut in September. I'm not sure. We do have the Jackson Hole Summit coming up. I believe it's August 21st through the 23rd, is something along those lines next week. And Chairman Powell will be speaking. There's been a lot of Fed speak lately with the Fed governors talking about their views. As you know, there was a dissent in the last meeting, first time since 1993 that two governors had actually dissented against the majority rule of no rate cut. And now the expectation is that if they don't cut in September, there's going to be far more dissensions, maybe 4 or 5, which could set a record that's never happened before. But regardless of that, that is going to be watched like a hawk. Pretty much anything Chairman Powell says. And what I was going to allude to is the fact that with all the Fed speak, Chairman Powell hasn't said much of anything since the last Fed meeting. He's been conspicuously quiet. But he's not going to be quiet during that Jackson Hole Summit. The press is going to be in his face and asking about September. And the market may move on every word he says. It's kind of fun when it happens like that intraday. So if we take a look at the dollar is hanging in there really well, staying in this Goldilocks channel, as I call it. We stay down here. That's the most ideal spot for equities to go higher. We don't want to lose the dollar completely, but when you keep the dollar lower, it helps companies from the exchange rate. Netflix talked about that in their earnings report, as I mentioned previously, and it works well for companies. We don't want the dollar to get too strong because that's a negative on the exchange rate. But again, we don't want to lose the dollar. We still need it to be the currency of last resort because we have so much debt in the U.S. We need all these foreign countries buying the dollar, buying our bonds that we issue every week. To service the debt that we already have. So we're already robbing Peter to pay Paul, as we say, and that's where we got to make sure that we manage the dollar properly. So not too high, not too warm, not too cold. Goldilocks. That's where that came from. All right, so let's go ahead and move to the bond market, and we'll look at TLT to start off with. Now, TLT, as a reminder, is the 20-year. Prices and yields move in inverse proportions. As prices go up, yields and rates go down. The TLT measures prices on the 20-year. You can see we kind of went up in price and therefore down in yields, and then we've come back. So we had this triangle. We broke out. We bumped right into resistance there from the June highs. Logical point to find resistance, and we've come back and tested the point of this triangle. Now the question is, do we turn and go back up in price and down in yields, or do we continue to go down in price and therefore up in yields? I think that's going to have a lot to do with how the market settles out with whether or not there's going to be a September rate cut from the Fed, and maybe we have to wait until Jackson Hole and the commentary from Chairman Powell to get a clear direction on which way we go on TLT. Another thing I wanted to show you is the update on the macros. The data scientists at hubb.com that do the AI signals that I mentioned to you before that you could subscribe to if you want, also analyze the macros, the economic macros. And so I have some charts to show you. And so if we bring up the first chart there, you can see the different colored lines in the upper left-hand corner. It tells you what those lines mean. Basically, the upper line blends all of them, and then the lower part of the chart has each individual line on its own. So you look at the upper end, you can see green is dominant. We're moving higher. That means the economy is expanding. If you come down to the lower one, you can compare expansion macros versus contracting. The red is contraction, and right now, the expansion macros are leading. It doesn't mean that we don't have areas of the economy that are contracting. Clearly they are, as the red is elevated. But it's not overtaking the expansion macros, so the economy is expanding, and that means that that's further fuel for the market to go higher. Then when we talk about a couple liquidity charts, we have one that shows the Fed. I wonder if there's a little politics being played in this. The black line is the S&P. You can see how we're continuing to move higher, but notice we're getting a little tick down in Fed liquidity. Is that Chairman Powell's firing back at President Trump, who continues to criticize him for not cutting rates yet? I do think we should be cutting rates, but who cares what I think? But A little bit of a tick down there. You don't want too much separation here, or you start to set up an opportunity for a corrective move. We need liquidity in the markets for the equities to go higher. And then when we look at the next chart, which shows financial conditions compared to the S&P, it's still okay. We're getting a little tick down in the blue line, which is the financial conditions compared to the S&P, but it's not as separated as you saw in the Fed liquidity versus the S&P. So things are still okay. We'll continue to monitor that. And if we start to get some divergence there, we'll let you know. All right, let's get back to the charts and look at TNX, the 10-year. I know y'all like to look at that. That's the 10-year. That's interest rates on the 10-year. And you can see that rates have gone down, but we did get a tick up there today. And so we're a little bit higher in rates, but kind of holding this line here of support in the 42 area on the TNX. And like I said, I don't know that we're going to get a whole lot of action out of the bond market until we get to Jackson Hole. After the CPI and the PPI, that's going to be the next big economic event that occurs. All right, let's go to cryptos, because cryptos have been the story lately, and then we'll get back to metals, etc. So I'm going to look at BITB. I know a lot of you like IBIT. Both of them are very good with options. IBIT has weekly options if you really want to play this on a shorter term basis. But if you want a good leverage way to play the cryptos, these ETFs, options on the ETFs give you very good leverage in the crypto market without buying partial coins, etc. I know a lot of you say, well, why just not buy a partial coin? Why do you have to buy the ETF? Well, when you trade options on the ETF, you get better leverage. So you can see we had this breakout move. It was advertised here by BITB as Bitcoin moved back above 120,000, pulled back, went up and tested it again, and we're kind of hanging in this area around the point of the triangle. There's a lot of people smarter than me in the crypto space that say there's a lot of short interest around 120,000 on Bitcoin. If Bitcoin can push through that, then we're off and running. And then looking at Ethereum, gosh, there's been a lot of talk about this. A lot of you are familiar with the name Tom Lee. He came out today and said, or yesterday, I think it was, he thinks Ethereum is going to overtake Bitcoin. He thinks they're going to flip-flop. And Ethereum is going to be king over Bitcoin. That sounds like a pretty bold statement to me, but nonetheless, we've had this stair-step move higher in Ethereum. We're in another consolidation phase, and if you're long the cryptos, you would like to see Ethereum go sideways for a while before the next advancing move. You can see even with this downward move, we're still well above the 10-day moving average, and we can continue to consolidate before the next stair-step higher. But there's some wild predictions on where Ethereum can go. Another one of Tom Lee's predictions is if there's just the same ratio between Ethereum and Bitcoin that there was in 2021, which they've separated because there was a period of time where people seemed to just forget about Ethereum, where it was coming down here. It wasn't participating in the other crypto space, especially Bitcoin, moving down here. That ratio separated a bit. So it just comes back in line with 2021. That puts Ethereum at about 16,000. So perhaps that happens. Again, not my prediction. That's from Tom Lee. I know a lot of you made comments before that you follow him, so I thought I would throw that in there. Let's move into the energy space. We'll look at natural gas first. We finally got a little bit of a blip up today. A sign of life, if you will. The wave 5 went down almost to 100%, right at the midpoint of this tap box, stands for time and price projection in Elliott Wave. And so maybe we can break higher, but as you see, the closing price still stayed below the 10-day moving average. So if you want to be long natural gas, there's a lot of reasons why you would think that the fundamentals favor natural gas going higher. The fact that all the data centers are going to be using it. We're about to move out of the summer into fall and winter time when natural gas is used quite a bit. So there's some underlying factors there. But the other side of the coin is the markets are supply and demand. The markets are generally supply and demand driven by fear and greed. That's it. If you want to summarize what equity markets are in one phrase, that's it. And we are flush with supply of natural gas. That's what's been holding the price down. Perhaps, maybe, we can start to get a view ahead to the winter months. I've talked about how in certain parts of the country, and I traveled a lot over the summer. It was a hotter than normal summer. Maybe we have a colder than normal winter. Maybe that puts a bit under natural gas, but we have a one-day move here, and again, one day means nothing. We'll have to watch natural gas on Monday and see if it moves back to the upside again. Then maybe we have the end of the wave 5 and a retracement back up at least towards that wave 4. That's how Elliott Wave rules work. Then we look at oil, USO, staying in that channel. I don't get everything right. I'm wrong a lot, but this one I've gotten right all year on USO is that we're going to stay in this channel here between 60 and 85. I felt like at the beginning of the year and the market outlook that we were going to stay here through the balance of the year, and so far we have. Right around 75 is the sweet spot, I think, for OPEC Plus. That keeps prices of oil elevated so they can make some extra money on the amount of oil they have left in the ground. I've talked about this before, too. They've done their geological surveys. They know they're starting to run out. They want to make as much money as they can, but they don't want oil to go so high. You might think, well, why don't they want to push oil prices as high as possible then and make as much as they can? Well, if oil prices get too high, it's going to push people into electric vehicles, and OPEC doesn't want that. So they're happy with USO around 75, and it seems to want to stay there at this point in time. Let's go back to some of the equities markets before we move forward. The Dow had a move to the upside today, basically driven mostly by UNH, which I'll talk about here. I've got UNH. You guys asked for it. I have it on the screen to show you today as well. And finally, you can see that wave 5 there. After all this time, finally, the Dow made a new high. It took out its February highs. It went up and bumped its head against it back here in the end of July. Had tried it earlier in July, these February and December highs, but finally a new high today on the DIA thanks to the big move. It added 350 points to the Dow on just UNH alone. So that's why the Dow is breaking higher. We have this triangle here, and perhaps we move up towards this wave 5 high around 460. So we get the S&P maybe to 652, maybe the DIA up to around 460. And then we move into the Qs. The Qs have been staying really strong. We're still in that tech sector loving environment, the retail public that has a lot of money on the sidelines and money market accounts. Still really likes those top 7 or 10 tech stocks driving the market higher. And what's amazing to me is how narrow this uptrend is. Old-fashioned uptrend, just connecting a line of higher highs and higher lows. That's a pure normal uptrend, but this one is so narrow. It's just a nice, steady march higher on the Qs. We're still above the 10-day moving average, even though a little bit lower on the day-to-day, but as long as we stay above the 10-day moving average and stay in this line, we don't know how far the wave 3 can go. I've talked about this a lot. A lot of people say stay away from the wave 3 in the world of Elliott Wave because you don't know where the wave 3 is going to end, the wave 4 is going to begin. And I've always said if you have a zigzag in the wave 3, you can figure out where the wave 3 might end, and you can trade the wave 3, the strongest of all waves. But there is no zigzag in the Qs, so we don't know where that wave 3 is going to end. So we follow this channel and the 10-day moving average and see where we're going. And right now, it's just that nice 45-degree angle that I like. Not much to dislike on the Qs. Then we go to the IWM. Finally this week, we hit 230. I've been talking about this for a number of weeks. I thought back here in early July, we might be running. I felt like once we broke above, and if you've been watching these recordings, you know I've said this, that if we broke above 220, I thought we'd go hit 230. We moved up, fell back down, tested 220 again, made a slightly newer high towards the end of July, and then a move down, tested the 50-day moving average. We broke it, but only one day, no follow-through or confirmation day, right back up here. And then finally this week, we did hit 230. Where do we go from here on the IWM? Really don't know. It's a risk market, and it's going to depend on interest rates. The IWM, the Russell, is the most interest rate sensitive of all the markets. So what happens with the Fed, whether they cut in September or not, is going to tell you where the next move of the IWM is. So we're in the tap box of the wave 5, and it's anybody's guess where we go from there. Literally, you're just guessing if you're trying to pick a direction on the IWM at this point in time. Let's move to metals. So we'll look at gold, which cannot figure out what it wants to do. It keeps acting like it's going to break out one direction or the other, and in the end, all it's doing is forming a larger triangle. All I can tell you is that gold is going to make a significant move in the not too distant future, but I can't tell you what direction it's going to be. If it breaks higher, that's the target up around 330. But you have to respect the fact that in this symmetrical triangle, you could break down as well. And if you break lower, you're probably looking at down here around this 290 level would be my expectation on a lower break. So 330 the upside, around 290 the downside. We just have to wait and see which way gold goes. But the GLD has a extremely well-formed symmetrical triangle. It is going to make a move. Just can't tell you where. And then when you look at the ADX of the DMI, it's so low. You rarely see an ADX that low. It got down there in July. Now we're back testing it again. When the ADX breaks below 10, that's rare. The ADX is a signal within the DMI that measures the strength of a trend. Normally, you want to see the ADX moving up and above 25. That tells you the trend you're in is strong. When you have a low ADX, it tells you you're trendless. In other words, you're in consolidation. So having such a low reading like that means that the breakout is likely imminent. But again, we don't know what direction it's going to be. We just know that something's going to happen soon, and it's going to happen in an order of significance on gold. And we look at silver. There is no triangle on silver. At least there hasn't been yet. We've got this kind of a symmetrical, and I've talked about this a lot with our subscribers at Evo Trader. I like symmetry in Elliott Wave patterns and zigzags, etc. I've talked about this before. The AI nailed this level here for when silver broke. It called it right there on that bar. We went up, hit that level, stayed there for a month, and then went higher, came back, formed a wave 4, tested the 50-day moving average. You had three things highlighting the potential for a wave 4 there. You had a 38.2% fib level. You had support there from the sideways movement on that vertical move. And you also had the 50-day moving average. All three of those converged to add support. And we're just kind of getting this slow, steady march higher in silver, which is constructive for it to continue to go higher. Likely not to break out to the significance that maybe gold does. So we're just kind of trending higher here in silver, where gold is going to make some sort of a significant move to the upside. Likely. All right, so let's get to some stocks of interest. And I wanted to talk to you about the first one on the list, which is Netflix. Netflix is one we talked about a lot in our Trade Finder events. And by the way, if you haven't signed up for Trade Finder, you can do it with the link that you see on your screen now. You can go to evotrader.com and sign up there. It's free. We do it every Tuesday at 1 p.m. Eastern Time, so it's during market hours. We look at the market, we look for trade ideas, and we have a live Q&A, and we have an amazing community. They all talk back and forth with each other, share trade ideas. They ask amazing questions. It's my favorite event that I do each and every week. So if you haven't signed up for Trade Finder, please do so. And by the way, while I'm talking about that, if you like these videos, please hit that like button or hit subscribe. We're so close to 50,000 subscribers. Want to push through that. You know anyone else that you think might be interested in? It's free. All it does is gives you instant notification when one of these videos is posted, but it helps us out a lot if you hit that subscribe button. So please do so. Looking at Netflix. So the question was that came up, I think Netflix may have turned the corner. Rob, what do you think? That was the exact question. And I agreed. We came down here. We found this wasn't significant support, being fair, in this area right there. But it also coincided, once again, with a 38.2% fib level. So we found support there, that tiny bit of support from the May highs, and we've been moving higher. If you're very aggressive, I usually like to try, because everybody has different investment objectives, right? Some of you are aggressive, some of you are more conservative. You have to trade within what's comfortable for you. If you're super aggressive, I think you could take a long position in Netflix right now. If you're more conservative, let it break above this trend line here first. So something above the 1250 level. Let it get above that, and then perhaps we're off and running onto that wave 5 in Netflix. But if you're a little more conservative and you're like, oh, I'm not a big risk taker, wait. If you're super aggressive and say, you know, I've got discretionary money, I know the risks, maybe you step in now. You're least likely to get a move up and test that level. Then we'll see what happens from there. And then moving on to AMD, which I've gotten a lot of questions about lately. And it seems like every trade finder lately have been asking about AMD. it was kind of in the area of Ethereum in the crypto space where it was just not participating in the tech move to the upside. And then all of a sudden, everybody's like, wow, look how low AMD is. That looks like a good place. And that's what happens with money rotation. You may have seen it in some energy stocks today. Just today, there was a movement into energy stocks that have been severely lagging. So we had EMPH, some other ones that had nice moves to the upside today. But looking here, we have this triangle area here. We kind of broke out, no follow through day. So we didn't get the continuation of the breakout. We're coming back down to the 10-day moving average, probably going to test that point of the triangle. And then we'll find out if this was a false breakout or it was a breakout, test of the breakout. And then we continue higher in AMD. We'll have to wait and see how that plays out. Then we look at Nvidia just kind of doing its thing. Continuing up in this 45-degree angle, ascent here, following along the 10-day moving average. If you're long Nvidia, I don't see any reason to get out. If you're looking for an entry, you might say, well, it's kind of consolidated over the last couple of weeks. Maybe this is a good entry. Maybe it is. Once again, there's no zigzag in the wave 3. Very difficult to figure out where the correction may start in Nvidia. But for now, there's no real technical reason to short Nvidia or exit a long position, if you will. I also wanted to show you UNH. You guys ask about this. And while I'm talking about that, I ask you to hit that like button or hit subscribe. Each and every month this year, we did it last year, we're doing it again this year, we're giving away one of our free level 3 subscriptions. Well, the subscription's not free, but we're giving it away for free. It's our 3 primary portfolios at ewotrader.com. It counts our time strategy, which is looking for stocks to go sideways. It's an income-based strategy. It also counts the volatility strategy, which are those triangles. We use a unique way of doing strangles that mathematically sets you up for the greatest profit that you can make on the breakout. Still has to break out, but we do it mathematically the best way possible. And the AI signals on the impulse strategy, which is the directional based strategy. It's all 3 portfolios together, which if you were to subscribe to them on the website, is worth thousands of dollars. All you have to do to enter the drawing is leave a comment under this video. If you're a subscriber and you leave a comment, you're in the drawing. And so best wishes to all of you. But so let's go back to the chart of UNH, and you can see it held. It did make a new wave 5 low. If it didn't hold this 250 level, it's probably going down to 200. But once again, when it broke 250, no follow-through day. I keep emphasizing these rules because they matter and they're great to incorporate in your own trading system. And so no follow-through day. We went back up to 250. We broke above it. And then the news that drove it to the upside today was the fact that in securities filings, it was shown that Berkshire Hathaway, Warren Buffett doesn't run it anymore, but Berkshire Hathaway had taken a large position in the quarter in UNH, and that forced a lot of shorts to cover, and then you had this big move to the upside. Now, where does it go? Well, the problem is, if the wave 5 was over, we're already back to the previous 4. That makes it a little trickier. We have this gap here. Majority of gaps get filled. We don't always know when. Sometimes they get filled soon. Sometimes it takes a while. But at this point in time, kind of difficult. That was the big move you were looking for in UNH. It's very hard to figure out where we go from here. You can see it traded in this level through May and June and through mid-July. And we're right back there, likely to have some more sideways movement here. So tricky on UNH now, but hopefully you caught that move as we reverse back up above 250 and back above that 10-day moving average. A few more stocks of interest to look at here. Microsoft, we take a look at that. Nice consolidation here. We had this big blip up here, a little bit of FOMO action going there. Got a little too far from the 10-day moving average. No security in any time frame. It gets too far from the 10-day moving average for long. And what goes vertically up oftentimes comes vertically back down. Microsoft, good example of both those rules. And we're just kind of consolidating here. Again, if you're long Microsoft, no reason to get out. If you're looking for an entry, this might be a decent one as long as the market holds. If the Fed comes out very hawkish at Jackson Hole, maybe we get a little bit more of a pullback because the market is still expecting that September rate cut. And if that comes off the table, maybe we have a little bit more to the downside. We look at Amazon, taking a look at the chart here. There were good retail sales numbers that came out today. That's supportive of Amazon. And it's moving higher. If we can get above that 240 level, then we're likely moving up to that wave 5 there around 255 or so on Amazon. Once again, from the aggressive conservative view, if you're aggressive, you can go long now You probably get a move up to 240 at least, might bump your head against that wave 3 high. If you're conservative, let it break 240 first before you get in and move to the upside. Apple, which had a big move to the upside following that meeting with Tim Cook and President Trump, where they came up with an accord, if you will. For those of you that are Pirates of the Caribbean fan, they had an accord where Apple's going to buy into U.S. companies for another $100 billion, and the U.S. agreed not to slam them with tariffs for building the iPhones in India. So they can keep their plants in India. President Trump at one point had wanted them to come back to the U.S., so they came to an agreement there. That sent Apple soaring to the upside. It came out of this triangle, kind of gave us a little bit of a false breakout here, formed a larger descending triangle, and then up to the upside we went. I've talked about this before. Descending triangle does not mean we're going to break down, and Apple's a perfect indication of that. Well, look where we are now on this zigzag pattern. We're right at the 161.8% level. That's an extended level. We had a 50% B-wave correction. The first level was 100%. The next level is 161. Once again, hard to figure out where Apple's going to go from here. Likely some sideways consolidation, backing and filling following that big move to the upside. Fig, I wanted to bring that one up again. A lot of you ask about that in Trade Finder as well. Obviously, hasn't been trading public that long, so not a lot to talk about here from a chart standpoint, but options are now available for Fig, which is going to bring more liquidity into it. If you're super aggressive, and this is the only way you would even want to take a look at something like this, if you're super aggressive, the fact that we're holding here around the 80 level, you could take a shot at it. It's a pretty good risk to reward scenario, because if you break below 80 with a follow-through day, you're out. So you have a really tight stop. And maybe if it breaks to the upside, you can catch a little bit more of a run. I'm not talking about this kind of craziness that occurred right after the IPO came out, but maybe we start to make a move to the upside. But once again, your stop is right here, so you don't have much risk in that. If that's something that you want to look at. And last but not least, to finish off this recording, Tesla, which looked like it was breaking to the upside, but it bumped its head at 350. Logical point. There's resistance there. We came back. We've tested the 10-day moving average. This will be one to watch on Monday. Can we bounce back above that 10-day moving average on Monday? If we can, then you go higher. If you're looking for an entry on Tesla, let it get above 350 first. The reason I say that, you might have said, well, some other ones, you said if you're aggressive, you can trade it up to resistance. But we already tested resistance on Tesla, so that's not on the table like it would have been in some of the other charts. So we tested that already and it backed off. So the entry to go long Tesla, if you're not already long, is a break above 350. If you're already long, no reason to get out. We could come down and test the point of this triangle, even the 50-day moving average. If we broke below that, that would be your stop. But for now, if you were long, no reason from a technical standpoint to get out. Thanks so much for your attention. As always, appreciate it. Have a great weekend. Look forward to talking to you soon. Take care, everybody. If you like these recordings, I'd like to invite you to join our new Trade Finder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.